Wow, the end of the financial year is just around the corner. Can you believe it? This first half of the year has just flown by. Hello, I'm Jo Natoli. I'm the principal of the Rental Specialists. Today, I've got 5 tips for you to get yourself ready for the end of the financial year. Tip number 1, speak to your property manager. I always advise investors to view their investment property as a small business and do what is strategically important to maintain and improve it, which in turn may have a positive effect on the bottom line. Now is a great time to speak to your property manager and consider any repairs and maintenance issues you may have been putting off or you may not even be aware of. Number 2, speak to your accountant. Tax deductions are a really important part of cash flow and they are a legitimate claim for a property investor. You should be seeking advice from your accountant about deductions now. Don't wait till after the 30th of June, it's too late by then. Having a conversation with your accountant now will enable you to see if there are any benefits in bringing forward some tax deductible expenses to the current financial year, or maybe even prepaying your interest. It's essential to get sound, qualified advice that's specific to your personal circumstances from a property savvy accountant. And remember, as legitimate as tax deductions are, they shouldn't be your only reason to invest in a property. My tip number 3 is to brush up on your knowledge. It's really important to understand the difference between repairs and maintenance and improvements to a property. This is relevant as you can claim an immediate deduction on repairs and maintenance if the property is rented, whereas improvements need to be depreciated over time. A repair is when you return something to its original state. For example, you're repairing a portion of your boundary fence that started to lean over. Maintenance is where you're preventing or fixing deterioration, such as painting your property. An improvement, on the other hand, makes something better than what it was originally or provides something in a new or more valuable form. An improvement could potentially improve the property's income. For example, if you replace an old carport with a brand new brick lock-up garage, building a new garage is beyond repairing the old carport. Generally speaking, you can claim an immediate deduction on repairs and maintenance as long as your property is being rented. With improvements though, you can claim either a capital works deduction or depreciation, depending on the type of improvement. The ATO website, residential rental properties is an awesome reference and contains everything you'll need to know. You could also think about talking with your accountant about this, or even a quantity surveyor may be able to assist. Tip number 4, get your affairs and paperwork in order. If you're using a property manager, then at the end of the financial year, you should receive a financial statement that details all the financial transactions for the fiscal year in one easy to read document. It's best if your property manager pays all of your outgoings on your behalf, including statutory payments, strata levies, and any repairs and maintenance. That way, the end of financial year statement becomes a completely comprehensive document encompassing the whole of your property for the whole of the year. And if you ever need to top up funds throughout the year because the expenses exceed the rental income, this is usually easier to keep track of than using random receipts. If you don't use a property manager, then get all of your income and expense documentation ready now. Don't just throw it all in a box and hand it over to your accountant. Tabulate everything in an orderly manner in a spreadsheet and compile your income and expense receipts in an organised fashion to give to your accountant. Some of the items that you might be able to claim as immediate deductions includes advertising for new tenants, your accountant's fees, the cost of a depreciation schedule, property management fees, land tax, water rates, strata levies for a strata titled property, gardening, pool maintenance, building and landlord's insurance, pest control, interest on your loan, and repairs and maintenance. And there are plenty of things you can't claim, so it's really important that you have an accountant prepare your tax returns for you. Our tip number 5 is to get a depreciation schedule. Engaging a qualified quantity surveyor to prepare a depreciation schedule is one way to ensure you're claiming accurately on items that depreciate over time. It's easy to get one, and you usually only need to get it once unless you undertake some major renovations to the property, in which case it would be a wise idea to get another one. Once you have it done, you just give it to your accountant and your accountant will do the rest. Your property manager should also be able to arrange a depreciation schedule on your behalf. I did say at the start that I have 5 tips, but I've just thought of a 6th one. I often see investors who are complacent or don't have regular contact with their property manager. An active relationship with a property manager is essential to maximise your property investment small business. It helps you remain aware so you can capitalise on any available opportunity to maintain and improve your property's value and ongoing appeal to tenants. So my last tip is this. If you have an investment property in Sydney and you either don't have a property manager or you have a property manager but don't have a relationship with them, then I urge you to contact me so that tax time next financial year, you'll be completely prepared and on top of everything. If you'd like any further information about this topic or any other matter relating to your investment property in Sydney, please don't hesitate to contact me. I would be delighted to help. Take care.